I was beginning to think it wasn't going to connect. Good morning, everybody. It's Monday. We get to do it all over again. It's a quiet week. We are going to an FOMC decision, and they have a blackout period or a quiet period before that. And so we are getting into that. This week is going to be mostly a laid back week when it comes to how many reports are coming out and how impactful those reports are. There are auctions this week on the 3, 10, and 30, and it's the first set of auctions since quantitative tightening has begun. So it's going to be interesting, to say the very least. So as we're looking at finance juice here, on the side, they usually do a really good job of pointing out if anybody is going to be talking. Nothing there. Then they'll usually have something like a European market wrap every market. So they'll do one for Asia, they do one for us, and then there's one for Europe. Of course, Europe's still open right now, but it is in the later part of their morning or even into their afternoon by now, since it's 12:30 in London right now. So it's afternoon. China really has a lot to do with this bump this morning, and that does lead into the discussion of this whole move is part of a reflection of what happened Friday. Things that were up Friday are down now, and things that were down Friday are up now. So you get a little bit of that mean reversion. And it's a lot of the add to that, the warm, fuzzy feeling of, oh, maybe things aren't so bad. Just remember, another lockdown can just shut all of this down all over. All right, so we normally go to Market Watch. We've got the 3 and 6 month today at 11:30. The Investor Movement Index, if I remember right, this is the Thinkorswim thing. Yeah. So this one, I mean, it may have a little bit of weight, but they're basically, it's a TD Ameritrade evaluation of our accounts, right? On a broad basis, what kind of trading are most of their clients doing in the current environment? The higher the number, the more bullish their traders are. You can, of course, read more about that if you go to the Econo Day website. But so investor movement, we're not really expecting that to be very impactful, right? The 11:30 auctions, those can change a day, right? They can turn an entire day around. So definitely want to keep track of our lunch range today. It is worth noting this pullback and consolidation. And then one thing that really stands out for me is that lower high right there. Right? We had a higher high here. We have a lower high right there. And the reason I'm pointing that out is when you have this base and then you get a rally to the upside, and of course it needs to pause, it pulls back, and you get an equal high or less than an equal high, and you continue that move to the downside because it's just a pullback, right? It's a dead cat bounce, whatever you want to call it. Same thing. Set a base, rally to the upside. Kept setting highs and then getting new highs. Setting highs, getting new highs. Set a high. We did not get new highs. Started getting lower lows, lower highs, lower lows, lower highs, rolled on over, right? So take this with a little bit of salt. This market doesn't owe us a rally. Everything that was in place Friday is still in place today, right? Nothing changed except people's warm, fuzzy feeling because China eased some lockdowns and is finishing some investigations on some of their tech. That's it. All right. For today, we got an ADR of 2.5. We are already up 1%. So 2.5 from the close gets us right into 42.11, excuse me. 42.11 is a cog line, center of gravity. Should we get near that thing, we will very likely gravitate to it. And to the downside, that puts us right around 4,000 flat. Not necessarily a bad thing. Nice round number. So the ADR is an average daily range. You can see from the label, it's 21 days. So it's averaging up price movement through a normal day, all of the price action from the highest point to the lowest point, and just showing what we have been doing on a day-to-day basis. If you're unfamiliar with how you get an average of something, you add everything up and then you divide by how many things you added, right? That's how you get an average. So I added 21 days up. If, last Friday we moved, for an example, 2%, and the Thursday before that day we moved 1.8, the day before that moved 1.8, and the day before that 1.7. We just keep adding those numbers together until you've added all 21 days up, and then divide by 21 days. If you're on a broker that doesn't have an ADR, just use the ATR. The ATR is going to be very, very similar. It's just going to be front weighed a little bit. Think of the difference between a simple moving average, which is just doing the average that I just talked about, and something like an exponential moving average, which will have a little more weight in the front. Most of the time, you can get by with using an EMA or an SMA, and it doesn't really matter. Same thing with these. It doesn't matter, right? You're just trying to get a feel for what's the movement in the market right now on a day-to-day basis. That way we can plot out these expected ranges, right? So we could go down to 4,000, or we could go up to 42.11, and that would just be considered normal. Should we begin to move beyond normal, then we would want to focus on what we can do on a day-to-day basis. Something like the intraday expected move off of the options chain. So like we do every day, start out with what could we do? We can maintain the range, expand to the upside, expand to the downside. That's one of the three things that we can do. We are already outside of yesterday's RTH, but we are not out of yesterday's range, right? We still have yesterday's Globex. So our range would include 4190 all the way down to 4096, which is a really big zone, and I would rather have a smaller zone. So something like all of yesterday's range, the RTH high to RTH low, and then from RTH high to our Globex high. That would give us two different zones to focus on. Then from our own Globex high to the high of yesterday, so at that point we'd have three different zones. It's important to kind of keep some perspective on this rally and the why behind it, or the lack of a why behind it, right? This is nothing more than investor sentiment. The banks, the institutions, it takes them a long time to shift out of the positions that they're in, right? BlackRock, for an example, has been decreasing its Apple position considerably, but it had it had billions of dollars of Apple. And now BlackRock is no longer the greatest holder of Apple. It's like number 2, but it's not done getting out of some of its Apple position. And no, it's not going to liquidate all of its position, but it's certainly reducing its position size. And it's not the only one. They're not suddenly coming in here and buying up Apple. They're going to continue to reduce their position. I'm picking on Apple, but it's just an example, right? All of those darlings of Wall Street, Apple, Microsoft, Google, Amazon, Tesla, the selling isn't done. They're not done reducing their position size. So these little rallies to the upside, yeah, they're nice, but nothing's changed from Friday to today when it comes to, inflation, rate hikes, balance sheet, the war. So just kind of keep all of that in mind through the day today. Should we break to the upside and get past 4,200, which is this peak from right before the holiday or during the holiday, that little melt up, then we'll expand beyond that ADR. A good way to do that is take the ADR and divide it by half. The ADR right now is 2.5. If we took half of that, it'd be 1.25. Take that 1.25, add it back to the ADR. That'd give us 375 for the upside move. Right? So just draw a line from where we opened in the Globex or where we closed Friday, either one, it doesn't matter, and plot out 3.75, you'd start to get an extreme reading, right? That would show you what an extreme move would look like if we weren't just bullish, but actually got excessively bullish. And I understand that may seem like a long ways away. But if 2.5% is what a normal move looks like, then we want to ask the question, if we moved to the upside beyond what a normal move would look like, what would our targets be? Same thing for the downside, being able to ask that same question. We're looking at around 39.50. All right, as we usually do, want to come in and take a look at the volume profile. Realize right now that the profile is really wide, which it's not good or bad, right or wrong. It's just, it is wide. We always want to note that we have a dispersion in the volume across all of these 10 days. And there's still a significant level around 39.44. That is still where the point of control is for the TPO. Right now, we've got the volume profile, which is in green, with a point of control about midway through our Globex, right? If you consider where we opened Sunday night and where we are right now, well, I guess it's a little less than half. That point of control is below the market a little bit, right? We are still inside the box. When we get to the edges of the box, we have the expectation that we're going to go to the other edge of the box, and vice versa. When we're at the edge of the box, we expect to go to the box on the other side. So if we were to fade down this morning, we do have a significant level of volume around 41.22, old volume support. And we're going to consider 41.96, which is where that value area high is. We're going to consider that a level of resistance that needs to be managed when we come into that zone. It shouldn't be much of a surprise, right? Because we've got the high from Friday to deal with, but it's really close to that value area high. The concern would be, of course, that we get an inside day breakout and we bump our head against that value area high and then fade back in again, trapping a lot of traders. We do not have any point of control to carry forward. And there's no untouched value areas to carry forward either. Now, there is a logic that says you can carry forward the previous day's value area high and low, even if they've already been ran through. You could just carry them forward anyways. I don't really argue against the idea. I just don't see its merit, right? But if you wanted to consider that, yesterday's value area high be 41.30, and you can see when we did come up into that zone, price did respond to it. It did react there, but we're done with it. We've crossed through it. We've wiped it out. I don't see that it has any merit at this point, right? But there is still the argument that you could do it that way. It is worth noting the range here that we've been dealing with and the fact that we're still inside of that range, right? So in the grand scheme of things, we haven't done anything in over a week. Did a whole lot of running around and we're right back where we started, right? And one thing is at least we are holding above that 41.50, 41.60 area. So that's going to be a bit of a line in the sand. If we break Thursday's low this week, then we're very likely going to revisit the 38.60 area. All right, so we're looking at the weekly expected move. It doesn't always work well with futures for some reason, right? This thing is attempting to read the expected move for the week, right? And Thinkorswim doesn't really give us access to this in the coding, so it's not as easy to get this number as you would imagine. Plus, The actual number right there is a proprietary number that each broker kind of holds close to their vest. We have an idea of some of the ways that they get that number, but we don't have an exact science on how they get that number. So there's a square root of time in that. And then there's the averaging of all of the out of the money options, but we still don't know what else the secret sauce is, right? So that indicator is trying to mimic this number, but it's not a perfect science. When I bring up that indicator and I see it really, really wide, like it is today, right? And we're talking about this green line here and the red line down here, which is this week's range for the expected move. When I find it extremely wide in the futures, I always begin to second guess and doubt it. On the futures, for some reason, once in a while, this thing will go stupid and print really, really, really wide. If you see that, you just have to ignore it on the futures that week and go in and hand draw your lines. It's not a big deal to hand draw the lines. Just use the go back, because you can't use the number that's in there now, right? You have to use the go back. Look at where we closed on Friday and get the expected move for the week. All right, so we're looking at June 3rd. This is end of day data. There's Monday, Wednesday, and then there's Friday right there. And of course, no, it's not giving us what we want. There we go. Got to tell it what contract you want to use. Speaking of contracts, we're getting really close to the time that we're going to swap contracts forward in the future. So don't forget that as well, right? But the expected move Monday, Tuesday, Wednesday, Thursday, Friday. From last Friday to this Friday would be 7 days. The expected move was $110 higher, $110 lower. We're pointing this out because of how wide that thing looked, right? In relation to the rest of the boxes around it, that day seems a bit extreme. So it just doesn't hurt to check, right? Now, if I measure this thing and it says 100, then that exercise was for nothing. But it doesn't. It shows that it's 154 points. So that thing is way off base, right? It's 50 points too wide. So you wouldn't want to trust that weekly expected move this week using the indicator. You're going to want to hand draw your expected move lines for the week. It's $110 higher or lower from the close of Friday. And we closed Friday at 4109.50. We had some interesting um, technical analysis over the weekend. Apple had a death cross. And while a death cross typically is considered bearish through seasonality and historically speaking, when the S&P or Apple gets a bear cross, it turns into a buy signal. So, it's something to recognize that it's not necessarily considered a bearish signal all the time. In contrarian trade logic, right? If some of your darlings of Wall Street get a death cross signaling that it's at an extreme low, then it makes sense that a lot of people would just instinctively go in and buy more of it. It stays static. We don't want it to move. We want Friday's valuations. There's plenty of indicators out there that will do like a day-to-day expected move or count down the range of expected move, but we want ours to stay exactly where they were for the week. So that indicator doesn't change. God gracious. I have fat fingers today. We go and look at something like Spice, just because I had a very funny feeling the indicator would be working on a regular equity product. But if we look at SPY, these lines from the past here, that was the range of the week. So it's a great evaluative tool to look back. That was the range. And then you can use that range and see, what did we do for the week? Did we stay in the box? Did we leave the box? Did we leave and come back into the box? What was the size of the box? Is the box this week bigger than the box last week? Was the box last week a 3-day week, a 5-day week, blah, 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 blah. So it's great for evaluation because it has been locked in place and it doesn't move. And then it's also great for forward logic, looking forward, say, into this week and asking the question, what's this week going to look like? Notice right now there's no candle on SPY because technically speaking, we're not open yet. Could look at like the SPX. That way we don't even have to refer to a market that's not open yet. So with that in mind, I've got my hand-drawn lines on the SPX because I like to draw my own. So there's the EM high that I have marked and the EM low that I have marked. And then there's the indicators lines. Now, as I mentioned, the indicator can't reach that data. Thinkorswim doesn't give us, as coders, it doesn't give us access to that data. So we have to approximate it in some way. And I did not make this indicator, by the way. Mobius did, who's like a code genius. He built it for Don Kaufman, who uses these levels constantly. But Don hand draws his every week. And if you wanted to jump over from the SPX and say, look at Facebook or Amazon, you would have to go to the go back, look at where we closed on Friday, get the levels. What a pain in the ass. So if you can just get this indicator that will give you a close approximation of where those lines are, then you could jump from equity product to product to product to product and not have to keep going back and hand drawing those lines using the think back machine, which is cool. So it does its job. It's useful, it's valuable, but it's not as accurate as going in and drawing them yourself, right? Of course, who would want to sit there and draw out 50 freaking markets every weekend? I do it in the SPX and sometimes I do it in the Nasdaq, but for the most part, that's it. Everything else, I let the indicator do the work. All right, so we're looking at the Nasdaq, speaking of, and that range is true here, just like it is in the S&P. Keep track of that little pop out between Thursday and Friday and just recognize it as a little bit of a blow off top signal more than anything else. We've got a very wide range today, just like we have a very wide range in the S&P. The Nasdaq's got a 3.4 ADR, so this sucker can move. These ADR targets are old targets, so we need to draw these things out and put them in their spot. So we want to start with where we closed. Just draw a line to the downside, aiming for 3.4. Doesn't have to be perfect. We're just getting a ballpark. That puts us pretty close to 12.1. I mean, maybe 12.1 and a quarter. I really think if we get that close to 12.1, we're just going to go to 12.1, but I'll mark the line where it says it should be. So that's our downside ADR, and our topside ADR actually gets us above that blow off top from Thursday, excuse me, not Friday. So an upside move will be very close to 13, the roundy, and a downside move would be close to 12.1. Remember, if we get that close to a significant level like that, we're very likely just going to grind up to that or down to that level, right? So it's a significant range. Just like we did on the S&P, it's worth coming out to the higher time frame and looking at this linear regression. Keeping track of higher highs and higher lows. Now in the ES, this was not a higher high, right? In the S&P, this was actually a lower high, which was a part of my warning this morning when we started this stream, and I pointed out that we had a higher high, and then in the ES we had a lower high, but here we actually have a higher high. Now, that might not save anything in the grand scheme of things, but it is worth recognizing that the Nasdaq managed to print that higher high. And just like when we were talking about the S&P, we had the same thing happen back here, right? We built a base, we rallied, pulled back like we would expect to in a rally, failed to get an equal high or a higher high, and then began to roll over with these lower lows and lower highs. Same thing again. We kind of built a base, nice rally, set a high, failed to set an equal high, and made the move down. Sorry, I just got visited by a cat that wants to play with everything. All right. So this little rally up looks like nothing more than a dead cat bounce. It could turn into something else, but for the moment, especially with it having stalled in this range that we've been in for a week, uh, it, it presents like a dead cat bounce. I was listening to, let me make sure I get the guy's name right. David Hunter over the weekend talk about how they're pricing in the Fed's 50-point rate hike and how June is done, July is basically done, and that there's supposed to be 7 hikes this year and 7 hikes next year, and that the market has done a lot of that work already. He said it's very likely that the Fed does not actually hit us with all 7 of those, and that as we get into July, they're likely to reevaluate conditions and say that they're going to call a pause on these rate hikes, that they're not going to just leave the rate hikes on autopilot, hitting us with 50 after 50 after 50. Of course, he doesn't know, right? He's just looking at what the Fed has done in the past, how they signal one thing, and then look at what the market does with that signal and changes their mind, right? So if Friday's numbers are good, it's going to begin, and it's not going to be just Fridays. Friday's going to be the start. But if the numbers start looking good, it's very likely that you're going to see a signal from the Fed that they're not going to just hit us with 50 after 50 after 50, and that we're going to have 7 hikes this year. If they hit a pause on that and say they're going to call timeout, if they use that kind of language and imply that there may not be another hike until, say, September or November, we could see a significant rally in the summer months here and kind of coming into August. Most technicians out there right now are saying that this Christmas is going to be like the 2018 style Christmas when we were down deep in the lows. Of course, they're not calling for a rally like 2018, but they are saying that, by the end of the year, we're very likely going to be pressing into new lows, getting into some nasty market conditions. But before that, we could see a significant rally. It's not going to be in the candles. You're not going to see it by, measuring out your Fibonacci's and looking at your MACDs and any of that stuff. It's going to be directly connected to the language of the Fed. So you really want to be kind of on watch. They're on silent mode right now because they've got a meeting coming up and they have a blackout period when they have a meeting. So you're not going to hear anything from them now. Friday is going to be the start of this process. And we're going to be looking for them to start signaling that in their interviews and in any publications that they come out with. All right, we had a significant move in the Bitcoin last night. I mean, it wasn't like parabolic, but that is like the quintessential risk on product. When people are feeling bullish and they want to speculate with their money, Bitcoin is the first thing that comes to my mind. Right? It's a highly volatile product with a lot of risk. So you're feeling risky, you'll play around in the Bitcoin. So I keep track of this thing on a day-to-day basis. Is it up? Is it down? How much? It's up over 6.5% this morning. It's a significant move in relation to, let's say, the ES and the Nasdaq. But for the Bitcoin, that's not that bad, right? We've seen way more than that in a single day. Gold, it's when I started this stream, it had a reasonably decent pullback, but it's kind of it's taking it back. So it looks like gold's going to be retesting that Globex high, still a long ways off of the lows from Friday. So it hasn't recovered even half as much as the S&P and the Nasdaq has. With the bonds having those auctions this week, the 3, 10, and 30 are going to be auctioned this week. Really keep your eye on the bonds, right? And if you're a little astute, look at the move that we had in the bonds Friday and the move that we had in the equity markets Friday, and then the recovery, right? So the bonds are getting really close to, they were getting close to resetting that drop, that gap. We need to see them back above that 138 half. Half is 16. But at the very least, we need to see them hold 137, say 137.12. We want to see them stay above yesterday's low. That's going to be the big one, right? So they can move around a little bit. We don't want to see these really big extreme moves that we saw on Friday. And the best that we could hope for with the bonds today is that they just hold still and don't really rock the boat too much. It looked like the dollar was trying to wake up a little bit this morning, faded back out. Kind of keep your eye on the dollar, and that leads right into what's happening in the S&P and the Nasdaq. The Nasdaq is up 1.6 and the S&P is up 1.1. And when we look at what's up this morning in the pre-market, it leads right into the financials. All right, so we got the S&P here, pre-market change percent. We want to use the filter knock this name from 500 names down to 100 names, or just get it close like I just did. Once you kind of get it close, adjusting the color scheme helps things stand out a little bit. The really big boxes are your monsters of tech, the MOT, because the box size reflects the market cap. So with that in mind, you can see the MOT is looking really good except for Amazon. Of course, that is not right? It's split, so its numbers are off. No way it's actually down that much, right? So you're going to find this on a lot of brokers that they just don't do well with this kind of stuff. Now, once the market opens in real market at 9:30, the cash open, that's going to change. It won't reflect like that all day long, but you're going to find this kind of stuff in the pre-market, and you have to be prepared for that kind of logic. So Amazon's not down likely. I say likely because I haven't looked, so I don't know, but I would doubt it's down at all, and certainly not down that much. Yeah, it's not even printing yet. Typical Thinkorswim. But when you're looking at this heat map, you want to kind of get your eyes accustomed to the different sectors and the subsectors. So finance this morning is doing really good. We know that we need finance, technology, or frivolous consumer spending for the risk-on markets, right? So with that, when we look at the S&P versus the Nasdaq, we really want to see that the S&P has the backing of the financials, and if there are any financials that are not participating, pay attention to those. What classification or category do they belong in? When we take things back to like Thinkorswim, I tend to use the flex grid for this kind of work. You can break those ETFs down into these grids, and I've already got these grids pre-made. They're on the Bullish Bears Discord. So from here, if you're looking at something like XLF, you've got JP Morgan, Bank of America, and Wells Fargo. Notice I skipped over Berkshire. That thing tends to do whatever the hell it wants to do, so I don't lump it in. Same thing with BlackRock. It tends to do whatever the hell it wants, so I don't lump it in with its peers. But JP Morgan, Bank of America, and Wells Fargo, generally speaking, all respond with similar charts most of the time. You'll find them almost in sync. And then Citi, Goldman Sachs, and Morgan Stanley, also similar charts. You'll find them often in sync. If one of these stands out with a significant move that the others aren't doing, look for the others to play catch up really quick. Like I talk about all the time, I don't care what you trade, but you should be particular about what chart you're looking at. So if you're trading Morgan Stanley, don't just sit there and look at a Morgan Stanley chart and ignore the rest of the market, because Morgan Stanley is not moving by itself. It's moving with the market. Right? Trading Facebook, don't just sit there looking at Facebook, look at the market. When you can find a market that's in a correlated market state and one of those products starts to do something, you've got a pretty good heads up that the other one's going to do it too. That little early warning can save your butt and get you out of a trade, or even better, help you not get into one and avoid taking a loss if you see a change happening on one that has not yet happened on the others. And yes, Amazon is splitting today. For anybody who didn't get that memo yet, Amazon is splitting today, and you're going to find a lot of brokers struggle with that split, and they're just not going to show anything until the market opens, right? Which is why when we were on TradingView here, it shows that it's down 94.93%. It'll adjust, everything will get situated relatively quick. This isn't the first time in the history that there's ever been a split somewhere, right? So you just got to give everything a moment to get caught up, come into the open, things will get normalized, and your brokers will be all right. Looking at the other retail this morning, it's not hard to assume that Amazon is probably doing pretty good if it's something that a broker would even allow you to trade in the pre-market this morning, considering this blackout that we're looking at here, right? But I am seeing a bid ask of 124.80 and 124.90, or 88 and 82. So yeah. All right, so now we're looking at the Nasdaq 100 pre-market change percent. We don't need a filter because it's already 100 names. We just want to change the multiplier so the colors change a little quicker. That way we don't get so many of these gray areas. The Nasdaq 100 does not have financials in it. So when we are comparing it to the S&P and how far the Nasdaq is up in the morning versus how far the S&P is up in the morning, that's one thing to always keep in mind. Generally speaking, the Nasdaq tends to be up more than the S&P on a day-to-day basis, but when it's not, go directly to the financials and find out why, right? Because that's going to be the game changer. The S&P has Apple, the S&P has Google and Microsoft, right? They both have the monsters of tech, the MOTs. So if they're significantly different like they are this morning, you really want to get a why behind that, right? And they're off by about a half of a point this morning. One of the reasons that I use TradingView in the morning is because of this screener right here. It's going in and asking a question, what's up this morning or what's down this morning and by how much? So if you look at the NASDAQ 100 pre-market change percent, how many names in the NASDAQ are up at least a half of a percent? 58. That's 58% of the NASDAQ this morning that's up at least a half of a percent. That's a generally bullish risk on sentiment, which thanks, Captain Obvious. We didn't need that number to figure that out. But when we see that a lot of markets are up or a lot of markets are down, we want a distance behind that, right? We want to be able to gauge it by being able to ask a question, say, like, well, by how much, right? So half of a point, not bad. It's a good place to start. If I'm looking for a very bullish sentiment, then I want to see how many names are up at least 1%. 44 names in the NASDAQ this morning, or 44% of the NASDAQ this morning is up at least 1%. That's some good, strong, bullish sentiment. You're going to want to reevaluate this as we get closer to the open. But if we come into the open in a highly correlated coefficient, we could see a significant move today, right? We don't have really anything on the econ books. So after Friday's move down, least squared method and linear regression alone says we're going to revert back to the mean a little bit. Kind of a dead cat bounce play thrown in there. So we could get a nice move today. I will be the person who continues to uh, stress caution. We've talked about this before. When you're in a market that's got a trend, whether that's a daily trend to the upside or a daily trend to the downside. And in this case, we're going to talk about coming up off of these lows and trending up. When you have a market that's trending up, it doesn't just go in a straight line because it's a trend. It has to have pullbacks. So you'll notice that it makes the move up in the daytime. And then in the Globex, you get that negative speak, right? It'd be markets around the world, and the news is going out there and poo-pooing on the market. And then when we come into the open, we're going down a little. And then it changes course. And by the end of the day, it closes higher than the previous day close. Then we go into the Globex, we go into after hours, it gets negative. We get into the RTH of the next day, we go down a little more, and then we rally up. Each day getting a higher low, and each day setting a higher high. That's what we would expect. in a market moving to the upside, a market trending up on a daily chart. Same thing if you flip it all around for the other side, going to the downside. So if we go out and kind of parse the logic out here on the daily, we've been down on the year all year. And with significant pivot points, we've just been maintaining these lower moves. It's just a pullback before going lower, a pullback before going lower. Now, it's worth recognizing that, yes, we did get a higher high. It's the first higher high that we've had in quite a long time, since that Fed move back on March 16, when we had that significant rally up after the Fed meeting then. We haven't had a higher high since that event. But just like with that one, what came next is really important. So this week right now is really important on this move that we're keeping track of to the downside. If we don't set and maintain this equal high and get a new high, and instead we start moving lower and we print a lower high, then this is validation or verification that we're going to continue to see that move down, and that this is truly nothing more than a pullback, than a dead cat bounce. All right. But we can't say for sure because this hasn't resolved itself yet. We do have a red to green this morning. It's one of my favorite setups. We'll get to that red to green, but we want to finish with these numbers first. So correlation coefficient, we've got 45 names, or 45% of the Nasdaq up more than 1% this morning. I would focus on the least up names, right? Names that I would expect to catch up with its peers, but have not yet made the move this morning, because I don't want to try to trade something that's already up 6.5 or 6.75%, right? I don't want to go long off of the highs when we're up already 3%. Now, it doesn't mean that you can't, but in the grand scheme of things, if something's already moved up 5% in the pre-market, and then we go into the open, you really think it's going to move another 5%? I mean, it can. We know that it can, but I would rather find something that has not yet made a 5% move to the upside and trade that. If you're looking for the flip, if you think they're going to dump this thing on our head, then you would want to focus on the names that are up the most, because they are the names that we're going to want to run down into the dirt, right? If they're up 5%, they can fall to zero and still not be considered having moved for the day at all. In the grand scheme of things, each market has an expected move. Think of it like a bubble around price, and price, generally speaking, will stay inside that bubble. So if it's made a 5% move one way, and we're thinking it's going to flip over on the day, going back to zero still means it can go 5% down after it gets to zero. So you can catch a 10% move on a 5% up market, and it wouldn't even be considered extreme. So that's the Nasdaq. Let's roll it over and look at the S&P. Same thing. How many names in the S&P 100 are up at least 0.5%? 56. That's not a bad number. I like that number, in the 70s, maybe 75 as we come into the open. If I'm going to run the alpha protocols today, I want to see at least 93, maybe 95% correlated coefficient. If I don't see that, I'm not running the protocol. Take the S&P and look at 1%. Only 30 names. And I say only, but that's still it's a significant number of names. So 30% of the S&P 100 is up at least 1% today. You really want to break that down into its sectors and see how many of those names are finance, and which finance is it. American Express, Morgan Stanley, Charles Schwab. All right, so it's not those financials that we were talking about earlier. Bank of America, JP Morgan, Wells Fargo. Remember that these are two different categories, even though they're all, quote, XLF, right? Consider these three in a group and these three in a group. When you're looking at the XLF, it doesn't hurt to take a peek at the KRE, which is regional banks. Because oftentimes it'll just provide a little bit of insight on what's going on out there, different names, right? So, generically speaking, when we say something like finance, that paints a very, very broad brush. It's worth doing the diligence to dig a little bit deeper and ask, well, what finance is it? The same logic is true for energy, technology, take it on down the list, right? The broad brush kind of gets you pointed in the right direction, but digging deeper will help you narrow down your focus. So, out of all of these names that are up this morning, remember the purpose of the morning briefing is to get you ready for the open. It's to help you funnel down 600 companies that have weekly options into something that's manageable as we come into the open. Most of the market is going to have the same R2G setup that SPY has, and SPY is the one with the R2G that I'm going to be pointing out in a minute. So if SPY has it, you know that at least 65-70% of all of the market has it. If SPY's got an ADR right now of 2.5, find something with a beta of 2, maybe 2.5, so that you can, catch an equity market making a 6 or 7% move today. It makes sense. All right, so we're looking at the sectors. The S&P 11 sectors that are out there is kind of an old school logic that doesn't take into account our modern world, right? So kind of broke out our own sectors, made a list for the EV market, the crypto market, pot stocks, things like that, since we don't have that old school legacy 11 sectors that encompasses those. So let's take a look at crypto. Crypto's doing really good. Most of the names in this list are up, right? And the few that are down, one name is significantly down, but the rest are either flat or positive by a lot. Now, I didn't build this crypto list. It came from the Smalls Exchange crypto futures product, right? It represents an index, a basket of stocks. I opened up the basket, took the names out of the list, built my watch list from it. So this list is not mine, but it is a list that I lean on. If it's good enough for the Smalls Exchange, it's good enough for me. All right. So, of course, we already knew crypto was up. We talked about Bitcoin earlier being up close to 7%. But we want to follow that up. What about the chips? Chips are up, and we're going to find everything's up, right? But when we're looking at something like this and we're looking at the sectors, remember that the capital rotation is important. So if high correlation coefficient says that 90 names out of 100 are all going to be doing the same thing, what's the other ones doing? And what are those other ones? Commodities, bonds, the dollar, precious metals, those products would stand out and would be expected to do something different than the S&P. It doesn't mean they have to, right? We're not talking about a teeter-totter where one side goes up, the other side has to go down. But think about Friday when we were in that sell-off. There was one sector that was doing really good Friday, energy. What's the one sector doing really bad this morning? All right, so looking at the EV market, again, all the names are up. Nothing really stands out here. And then taking it over and looking at the pot stocks. For the most part, all up, right? So on a day like this, when everything is up, you do want to ask those questions. What's not up this morning? Is it a harbinger, an early warning of something? Is it a part of that capital rotation? Are these the names that were up on Friday and are now just in the mean reversion in the other direction? Or are they down for a different reason? I can see, for an example, Aflac is down. Now be careful when you're messing with pre-market data and pre-market change percent, because a lot of times it's not pre-market, it's actually after hours. It was from Friday after the close, not from Monday in the pre-market. It won't make the distinction for you. You have to make that distinction, right? So if you're seeing that like everything is up and one name is down, go check and see if it's even had a print this morning or if it's still reading an after hours print from Friday. All right, so let's get into the red to green because this is going to be the setup of the day if we get the follow through. I've already marked SPY, and we'll start with the daily chart, although it may just be easier to go over to Thinkorswim for this. So red to green setup. Yeah, we'll just go to SPY. You want to look at first, where did we open on Friday? And then, of course, Friday was a sell-off. We were down. We quit falling at lunchtime, but we never rallied up off of it after lunch. All right. So that's Friday that I just marked out. And Thinkorswim on the daily chart does not show anything, right? So the pre-market today isn't showing. What we want to see on a red to green is in the later part of the day, on the previous day, that we began to rally up off of the lows, or that we have in some way left those lows. It doesn't have to necessarily be a rally. And Friday afternoon, I don't think anybody would really call that a rally, right? We just kind of held the line more than anything else. But we're up off of the lows, so it's not a, there is a bit of a wick there. And then we went into the close. So in the pre-market, what we want to see is that we get above the previous day's open. It's one of my check marks, one of my benchmarks, if I'm going to run the red to green strategy. I want to see that we're above the previous day's open as we come into the open today, because that's now a support level. It's an institutional pivot point. It provides support. So if we've rallied up above it, we come into the open, we bounce on it, get that Busby, and we can start to focus on yesterday's high for an inside day breakout. So this would be a red to green setup with the potential for an inside day breakout. And I'm talking about it on SPY, but with a high correlation coefficient, this is going to be a setup in a lot of names out there this morning. It won't just be in SPY, right? And we can use the ADR targets to try to identify, well, how far could we go? But we'd also just want to focus on those institutional pivot points, the open, high, low, close of the levels from last week. And you'll see that a lot of them, they line up really close. When they line up really close, just consider them a zone, right? We don't draw support and resistance with a sharpened pencil. We draw it with a fat, dull crayon, right? So kind of approach it with that same mindset when you're drawing your lines. This red to green setup is a phenomenal trade. I love this trade. I use it every chance that I get. But you're going to find today that there are a lot of red to greens. So you want to narrow down the list by your own metrics. Liquidity. Are you going to trade, options for an example? The options liquidity, the size of the strikes in the options, the cost of the market that you're dealing with. Maybe a particular sector that doesn't match the rest of your portfolio if you're looking for a swing trade. Use whatever metrics work for you to narrow that list down so that you're not coming into the open with 50 names on your watch list. That never works out, right? It never works out. One of the things that you could use is beta. So if Apple has an expected move of 2.5%, and you find something that has a beta of, say, 2, it's going to move 2% for every 1% of SPY. Tesla, for an example, has a fast beta of 2.5. I'm going to round up a couple points. So this is going to move 2.5% for every 1% of SPY on average. It's not a guarantee, right? But generally speaking. So if I think the S&P is going to make a 2% move, this could make 5% move, right? That's the kind of logic behind it. So if you're looking to narrow your list as you come into the open, look at things with a high beta, with a reasonably decent liquidity, a tight bid-ask spread, maybe a very narrow width between the strikes, right? Like dollar wide or even 50-cent wide if you can get away with it. Keep in mind, if we do get that rally today, we're very, very likely going to take a volatility crush. They will suck the value out of those options in an extreme way. So just straight up buying a call, I won't say that the call wouldn't make money if we rally. It will make money, but it's going to lose a lot of money due to the volatility crush. So stay with spreads. At the money spreads will neutralize those Greeks as much as you can neutralize them. So in a $1 wide spread on SPY, for an example, if you were to open that up and pay 50 cents, you're in a 1-to-1 trade and you're likely to make, if your max profit is 50 cents, you're likely to make 50 to 60% of that in the move today. Now, if you're thinking, well, that's not very much money, I want to make more than that. Great, make the spread bigger or put more lots on, right? I just used the $1 for an example, but you're in full control. And you're going to make 50 to 60% of that max profit if we get the rally today. You buy a call and you want to make 50 or 60% of the risk that you've put on in that call, we would need to see one hell of a monster run for you to make that same 50 to 60%, right? You're very likely going to make 15 to 22 cents on the dollar. So if SPY moves $1, that SPY call is likely to make, if you're lucky, 35 cents in that $1 move. There's nothing wrong with that in the grand scheme of things. It's money, right? It's profit. But if you do a spread, you can gate or shunt that volatility strip that we're going to see today. And that's not just for SPY. It's going to be for anything that participates in this rally today. They're all going to take that volatility rip. Sorry, kitty. You got to go. Lay over here. So that's what I got, everybody. Be careful. Be safe. I will see you all tomorrow.